welcome to slide pack 16 of the financial modeling program. What we will talk about today are some interesting financial ratios that really measure a company's performance on several different metrics and also allow you to compare one company's performance relative to its peers or its competitors. So what I've done is prepared a little Excel sheet where I have listed out some of these ratios. So what we will do is talk about these ratios one by one. And let's get started. So if you compare two companies, size is often a very common metric. Size matters. So Company A might say, I am bigger than you because I have more revenue than you. Fair. So comparison by revenue is one metric. Another company might say, I'm bigger. For example, a bank might say that I've got more assets than you have. So you can measure a company by its assets. Another way you can measure a company more from a owner's perspective is the book value, which is essentially what is left for the owners when you liquidate the assets and use the proceeds and the money from the liquidation of the assets to pay off all of your liabilities, including your debt and your accounts payable and your taxes and things like that. So after all of that happens, what you have is sort of the book value that flows to owners, and that also gives you a metric by which you can compare one company to another one. Now, operationally, there are a few performance ratios. Now, the very first, if you think about the income statement, is revenue. So, if you have two companies that are neck and neck on revenue in terms of the dollar amount of revenue, one company might say that my revenue growth over the past 3 years or the past 1 year or the past 4 quarters was higher than your revenue growth. Or if you're looking at a company for an acquisition or a valuation, you might want to compare how quickly your company is growing relative to its competitors, or relative to how quickly the industry is growing. Now, I've just slapped on a couple of numbers here. Let's just say that 231 is the revenue of the first year, and this could be thousands, it could be millions, it could be billions. And let's just say 272 is the revenue in the second year. So the formula is very simple. You basically have your second year revenue, you subtract your first year revenue, and then whatever you get, you divide that by your first year revenue. And what that gives you is growth with a baseline on the first year revenue. So in this case, the growth is 17.7% in 1 year using these numbers here. So revenue growth is always a good metric to keep an eye on. Then if you go down the income statement, logically, the gross margin, two companies in the same business, if one has much higher gross margins than the other, then that speaks well of the performance and the efficiency with which that company is being run relative to other companies in the business. And the gross margin is the gross profit divided by the sales multiplied by 100 to get a percentage gross margin. The operating margin is essentially the earnings before interest and tax, or the operating earnings divided by the sales. And I'm not going to talk about percentage every time, but all of these are percentage metrics. Another ratio is the EBITDA margin, which is the earnings before interest, taxes, and depreciation and amortization divided by sales. And then of course there's the net margin, which is the net profit divided by sales. And then for private companies to a lesser extent, but more so for public companies, a very important metric is earnings per share. So what's the net profit divided by the total number of shares outstanding? In other words, what does every shareholder get in terms of his share of the profits per share held? Now, other interesting and very important metrics factor in the amount of debt a company takes on. Because debt beyond a certain point can become a huge burden for a company, and indeed debt has often made companies grow very big. And the sad part is, at the end of the day, when those very same big companies have been unable to pay off their debts, they've had to file for bankruptcy, and that inefficiency with which management ran the company ultimately comes back to bite the shareholders, in that sometimes, not all the time.
Avast virus database has been updated.
Sorry about that. Sometimes you can have a company go bankrupt. So an important measure is debt by equity. Another measure is debt divided by the sum of the debt plus the equity. A third metric is debt divided by total assets. Now this one's interesting because if your total assets are, let's just say, 122 million, and you have a debt level of, let's say, 10 million, someone that looks at your financials says, not a big deal. You know, you've got 122 in assets, you can easily pay off this 12 million. But on the flip side, if you have debt of 100 million and you have total assets of 122 million, then you're teetering at the edge, or you're beginning to teeter at the edge, and that's generally speaking not a good place to be. So debt by total assets is a pretty interesting measure. Now there are other things that also matter. When you take on debt, you have to service that debt, which means that you have to pay off interest on that debt either every month or every quarter or every 6 months or every year. And so a company needs to know if it's going to be able to generate enough operating profit to pay off the interest on its debt. So operating profit, which is essentially your earnings before interest and taxes, or your EBIT, divided by the interest on debt, gives you a sense of comfort. So if the EBIT is 20 million and the interest on debt is 2 million, then you know that this company can very comfortably pay off its interests. Another example, if you make $6,000 a month after tax. Now, this is money that you have that you can spend, and if your interest payments on your various loans and your car loans and your mortgage add up to, let's just say, $2,500. So someone looks at this and says, you know, you get 6,000, you can pay off the 2,500 and you will be fine. On the flip side, if you take on a large house and your payments are in the range of about $6,000 and you only have 500 left over for your other expenses, then it's a very tight situation to be in. So essentially, EBIT by interest on debt is sort of a proxy for the money that you get every period divided by the interest that you have to pay out. So I think that that's a very important metric. Another thing that people look at is EBITDA, which is sort of a cash flow equivalent because you're taking out depreciation and amortization divided by the interest on the debt. Another very interesting ratio is EBITDA minus routine capex. So for example, you know, you might have to spend on certain upgrades and things like that. So EBITDA minus your routine capex divided by the interest on debt. Moving on. Return on equity is another way to measure a company's performance, and basically what that says is, what is the net profit divided by the average owner's equity? So if you're looking at a quarter, then it's the net profit for the quarter divided by the owner's equity that was sort of the average owner's equity through the quarter. And the way we do this in the financial world is you take the equity on the balance sheet at the beginning of the quarter, you take the equity on the balance sheet at the end of the quarter, and you add those two and divide it by 2 to get an average. So you take your net profit for the quarter and you divide it by that average equity for the quarter to get your return on equity. So this is a metric for shareholders that says, okay, you know, this is okay or not okay in terms of how the net profits provide a return to shareholders' equity. Return on assets is another metric. So if two companies have very different assets in terms of size, that may not necessarily mean that the company with more assets is performing better. So what matters is how well are you utilizing those assets. And I'll give you a very simple example. If you know, you run a taxi and I run a taxi, and if you generate a lot more in terms of your monthly profits from running that taxi business with that same one taxi than I do, then your return on asset is much, much better than mine, and that's always a better place to be in. So you can compare two taxi owners based on the return on the asset. And of course, there are many, many other examples that you can think of. So moving on, and I'm just going to move this up a little. There are other measures that talk about the amount of liquidity that a company has. So one interesting ratio commonly used again is the current ratio, which very simply is your current assets divided by your current liabilities. So this is a measure that tells you that on a monthly basis or a quarterly basis, are my current assets enough to take care of my current liabilities or not? And the thing is, you typically want to have a current ratio that's higher than 1, which means that your assets, current assets, are more than your current liabilities. Now, some people say, you know, that's fine, but items like inventory are very hard to quickly convert to cash. So let's take inventory out of current assets. Let's subtract it out. And then let's look at that ratio of current assets minus inventory divided by current liabilities. And they call this ratio the quick ratio. Now, quick ratio is a very popular ratio with the investment banks and asset management companies, and you know, it's something that people follow and track very closely. The other thing you want to look at is what is the working capital that a company has, which is basically its current assets minus its current liabilities. So, you know, what does the company have that it can then use to run the business on a day-to-day basis? And then a lot of people say, now if we take out the cash and if we take out the short-term debt payment that we have to make, what does our situation look like then? How liquid are we? So that's called the operating working capital, which is current assets minus cash minus current liabilities minus short-term debt. And you know, keep the parentheses here in mind. So you're basically you know, subtracting two numbers. The first number is the current assets minus cash, and the second number is current liabilities minus short-term debt. And that difference is your operating working capital. Now there are still more ratios. So there's sales divided by net fixed assets, which sort of goes back to the taxi example. You know, how well do you do on sales versus me if we both have taxis? The other metric that we've spoken of before in projecting the balance sheet is days of sales outstanding, which, to remind you again, is the accounts receivable that you need to collect from your customers divided by the sales that you generate per day. So what you can do here in the calculation is you can have the accounts receivable for the end of a quarter, and you can divide it by the sales that happened in the quarter divided by the number of days in that quarter. So quarterly sales by 90 days is your sales per day for the quarter, and you can use that. Or if you're looking at this from an annual metric basis, you can do accounts receivable divided by the annual sales divided by 360. And I'll scroll over so you can see it. This is the part that I'm talking about. Annual sales divided by 360 gives you your average sales per day, and that's what you divide the accounts receivable by. Now, there are other people that tend to say, you know, I'm not going to use 360, I'm only going to use the actual number of days that my company was in business. And that's those are different metrics, so different companies tend to have their preferences on how they do it. But what you have here is sort of standard Wall Street stuff. And, you know, Wall Street likes to keep it normalized, which is such that they can compare one company against another. Whereas corporate financial people within a company might choose a different set of metrics, very specific to their company. But from a Wall Streeter's perspective, they essentially want to be on a platform where they can compare multiple companies and very quickly come up with metrics and an understanding of who is performance-wise doing better than the other. Now, inventory turns we spoke about, which is again inventory divided by the cost of goods sold per day. And again, you can do this quarterly or you can do this annually. Days of payables outstanding basically reflects how quickly you pay off your suppliers and your contractors. So it's the accounts payable divided by the cost of goods per day. Then there are other metrics such as operating working capital divided by sales. And I've got this incomplete there, but we know what the operating working capital is from row 29, and when you divide that by sales, that's another operational ratio. And well, I think this total equity is something that we've covered earlier, so we can skip over this right now. So those, in a nutshell, are the various common metrics that you can use to compare one company's performance vis-a-vis another or vis-a-vis the industry as a whole. So with that, we will stop here. Thank you very much.